The Fed cut rates today, but what does that really mean for you? If you're a real estate agent or someone who's looking to possibly save money on their monthly payment through potentially a refinance, or someone who's thinking about buying a home, or a real estate agent looking to educate buyers or sellers, you're in the right place. We're going to answer many of your questions, such as, what happened and why is it important? Is it time to lock in your loan? Are rates going to drop? Are they going to go up? And many more. So stick with us for the next 10 to 15 minutes, as it may save you thousands of dollars.
Thousands of dollars.
Thousands.
Thousands.
Welcome back, Joe.
How you doing?
I'm doing great. For those of you that do not know this face here, this is Joe Harris, our Chief Operating Officer here at Morgan Financial, and personally the only loan officer that I know that's done over $1 billion of production here in Brevard County over your 20-year span as a loan officer.
It's a fair amount.
It's a decent amount for
Feels
us.
like a lot more than that, though. It's like $1.5 billion, but who's counting?
I think it's $1.5 billion.
Yeah. But, it's good to be back in front of the camera talking about such an important thing like the Fed meeting from today.
Yes. So a lot of you have been asking, a lot of you watched what happened with the Fed, but not many people know exactly what it means. So that's why we wanted to have you come on and answer some questions that we've been getting from most of our business partners.
Yeah, there's a lot of misconceptions around the Fed meeting, and we've talked about it a lot, and people still think it's something that it's not.
Yeah. It's confusing for people that are also even in the industry, so don't feel bad at home.
Right, for sure.
So the Fed did cut rates. What does that mean?
So the Fed cut their benchmark rate by 0.25%, okay? And this affects things directly, such as if you have a home equity line of credit, possibly a credit card, maybe auto loans, student loans, things like that, consumer debt like that. But it doesn't affect mortgages directly.
Oh, that one hurts a little bit.
It does.
I mean, good in the other areas of, helping out with all of those other things. But if the Fed cut rates today, what did that do to mortgage rates today then?
So the emphasis was on the Fed all week. Actually, the last couple weeks, like, oh, the Fed's going to drop the rates. What's that going to do for my mortgage? And the reality is that today when the Fed dropped the rate, you know what it did to mortgage rates? I think that's what you asked.
Yeah.
It did nothing. The rate went up and down real quick. Then it kind of leveled out because the rates had already baked into the Fed dropping by 0.25. So we already had lower rates the last couple of weeks.
So it sounds like it didn't really impact much. Why is that?
It didn't impact much because it doesn't directly impact mortgage rates. The Fed has zero control over first mortgage, the majority of mortgages. Now, it does affect some second mortgages or home equity lines of credit, like we said earlier, but it doesn't really affect the first position mortgages that you would use to buy or refinance a home.
Sure. You had mentioned a couple of the things that it affects. What exactly does the Fed rate affect? Is the dropping of the rate a good thing?
The dropping of the rate is good because it will help save the consumers a little bit of money. If they go to buy a car, they might pay a little bit lower interest rate. If they have a variable rate on their home equity line of credit, that rate's going to come down, so they're going to pay a little bit less for that money. If their credit card rate is typically tied to prime rate, which is tied to the federal funds rate. So the cost of borrowing will come down a little bit, and it creates, when they raise the rates, it's said to destroy demand because you're going to think twice about borrowing money if it's more expensive. Mm-hmm. So now that it's a little bit less expensive to borrow, people might think about borrowing more money, or the money they have or the debt they have is going to cost them a little bit less in many instances.
So it did free up a little bit of money for them.
It might have freed up a little bit of money over a large amount of people.
Gotcha. So what is the dot plot and how does that affect things?
So there's a lot of talk about the dot plot, and you're probably going to hear about the dot plot being talked about. And they don't do this every single meeting, but this is one of the meetings they did the dot plot. And basically it's a plot of dots. Imagine that.
Hashtag dot plot.
Yeah. It's a plot of dots that shows where the different Fed governors believe that the rates are going to go and if there's going to be cuts or no cuts. So I don't know if you have this on a question, I might jump to it, but basically they predicted this at this meeting that there's going to be 2 more rate cuts this year.
That was my next question is what's next for mortgage rates?
Okay. So that's not, but dot plot again is different than mortgage rates. Mm-hmm. So the Fed is predicting they're going to lower their benchmark rate 2 more times this year. Okay. Now, as far as mortgage rates, this is also the dot plot has changed over the meeting. So last year they predicted rate cuts that never came. Okay. So just because they predict things and they forecast them doesn't mean it's an absolute or a guarantee. And so that could certainly change. And what's next for mortgage rates? Mortgage rates might trend down, but nothing goes down, absolutely. It goes up and down and up and down. Maybe it might trend downwards, but you're going to see pockets of higher and lower rates as it trends down. You might have lower highs and higher lows or lower lows as you trend down. So it might go up. So you're going to have a lower high and then, lower high down. And so rates will be volatile, but they should be trending down a little bit.
You always said something in the past, a visual that stuck with me. It was kind of a bouncing ball. It's going to go down, but it's also going to bounce up a little bit before it goes down even further.
That you're going to have volatility on the way down. You're going to have lows and highs on the way down, and the key is to find the one that's right for you, depending on where you are.
So the question that a lot of our clients are asking is, should they lock their interest rates?
That's a great question. Should you lock your interest rate? Well, the question is, what's your time frame? If you're buying a house, if you're under contract right now to buy a house, no one really knows what tomorrow holds. And so with that in mind, look at where the rates are today. If you lock your rate, you know exactly what to expect. If you don't lock your rate, you're gambling. You are literally gambling because you're betting that the rates are going to go down tomorrow. And the reality is nobody knows, and they could easily go up tomorrow, even though I said the downward trend is a longer term thing that's going to happen. But what's your time horizon? Is it 30 days? Is it 45? Is it 90? If it's 90 days, you might have time to float your rate and find a nice pocket between now and 90-day closing. But if you're 30 days out, you don't have a lot of time. So if you like where the rates are now, I'd highly suggest locking them. And right now they are like around a 1-year low on the rates. So they're as low as they've been. They're approaching a 3-year low as well. So right now, if you have a loan to lock, I would say take the risk away and lock it unless you're okay with the risk of being unlocked and knowing it might be one of those pockets of a higher rate environment.
Sure.
Short term.
So let's kind of take a different angle or a different approach on it too. So I'm a homeowner. If there are other homeowners out there that are wondering when it's going to start to make sense to refinance.
Great question.
Should they be having those conversations now? Is now a good time to have those conversations?
It is absolutely a great time to have the conversation because it's either the right time now or you can be prepared for the right time and you work with a loan officer. My suggestion is to work with a loan officer. If you don't have a loan officer, we have a couple of them here that would love to talk to you. I'm sure we have put information down below that will give you good advice, okay? And here's good advice. It has to make financial sense. Good financial sense to refinance. There has to be enough of a benefit to make sense of the cost. And that's what you're going to look at. So if right now there's a way to benefit you and it makes sense that the cost is worth the benefit or the benefit is worth the cost, then you execute because you don't know what tomorrow holds. And if you could save a couple $100 or shorten your period or do something that makes sense for you, why wait on that? Because yes, it could get better or it could get worse and you might not have this opportunity again. No one has ever been 100% correct on the outlook on rates. And for the last 3 years, we've said rates are going to go down and we've been wrong, and the market's been wrong and the market's changed. So we never know what's next. So if you like what you see and it's saving you money and it makes sense, it's time to lock. Sure. If you want to gamble and wait for it to go lower, you can do that. You might miss out on what you have today. Bird in hand, right?
Right. I have a lot of real estate agent partners that listen to the podcast and that join us on the podcast. What should they be telling their clients that are asking if rates are going to fall further after this Fed rate cut?
Well, if they're getting asked by their clients, hey, what should I say to them? That's a great question to get asked because that means that they have trust in their agent, right? Mm-hmm. So what should they say? First of all, no one can predict the future. And if they're waiting for the rates to go lower, they might get that or they might miss out on the opportunity, right? And so we've seen this and we've said this before. When rates go lower, the pent-up demand of all the people that are waiting are going to come in, and then the choice of the house goes away. You're going to have less choice. The supply is still low. Yes, supply is more than it was a year ago, but it's still very, very low. And there's not enough homes. They can't build homes fast enough. There's a 4.5 million home shortage of supply. And that's not going to be fixed the next year or two.
Is that across the country?
That's across the country.
Mm-hmm.
And so if you have 4.5 million homes short, well, you still have a supply side issue. So if people do rush in, you're going to lose out on the choices that are currently out there. You might not have the same negotiating power of being more towards a buyer's market versus a seller's market. You might miss out on how long you want to close, what kind of concessions they might make towards you, closing costs they might pay. Those are the things you could miss out on if rates go down a whole bunch and a bunch of people flood in. In the meantime, rates are as low as they've been in a year and pushing towards that 3-year mark that it makes sense to take a look at it right now. So your question, are rates going to further drop? The answer is possibly over the longer term, they could drop further.
Okay. Last question for you. You kind of dabbled a little bit on this as well. Could future Fed cuts finally bring mortgage rates lower, or should buyers act now?
So the future Fed rate cuts don't have an impact directly on mortgages. When the Fed says we're lowering the rate by a quarter, that doesn't mean mortgage rates go down by 0.25%. It means the federal funds rate, which affects HELOCs, car loans, credit cards, things like that, student loans, it affects those things directly. I mean, they will see if it's not a fixed rate, it's a variable rate to those things, they're going to see their cost of that borrowing go down. Mortgage rates depend on what's called the mortgage-backed security market. And not to get too detailed, basically, it is a bond market. And if there's more demand for that market, the price goes down. If there's more demand, the price goes up and the yield or the interest rates go down. And right now, the same things that drive people to the mortgage-backed security market would drive people to a treasury market, which is lower inflation. All right. So if we see inflation lower, you're going to see mortgage rates come down with inflation. If we see inflation go up, you're going to see mortgage rates go back up. And that's a fear and a concern of many. So I think I answered your question.
You did.
But will the Fed pull rates down more? Yeah. But if the Fed rates drop further, the same things that's making the Fed rate drop would not always make mortgage rates drop too. So we could, but if it's a matter of inflation and not job loss and things like that, which is why they dropped it this time. Inflation is still relatively above their target. But there is an overstatement of job growth over the last couple of years, and that had to be corrected. So we didn't make as many jobs as what was previously stated. So that caused the Fed to drop the rate. And so if that continues, mortgage rates won't necessarily drop because of that. So further Fed rates, to answer your question, won't necessarily drop mortgage rates further. We might be at a place for a little while on rates, or it could go further down depending on data that comes out in the next couple of weeks.
But everything's looking pretty good today.
Everything is looking, we've seen demand increase significantly, more calls in, more people refinancing. We had a 60%, the nation had a 60% increase in refinance apps last week.
That's incredible.
Yeah, so a lot of people are out there trying to refinance their loan. So if you need to refinance your loan, give us a call here at Morgan Financial. Our information's down below. We would love to hear from you and take a great care of you.
Yeah. Well, thank you so much for joining us again, Joe. We appreciate your wealth of knowledge. And for those of you that have not done so yet, please like, subscribe, or share with a friend or real estate agent who you think might benefit from this podcast. Thanks for joining us.
See you next time.